On the Express this week, week 4 of the government shutdown and no end in sight. A potential trade truce has markets melting higher. It's Fed week. Grab some clippers. Shannon Sacoccia drops in for a few good minutes. Beyond Meat gets grilled. The Investopedia indicator and what to watch this week. No tricks, no treats, just investing finesse. That's how we ride on the Investopedia Express. Welcome back and welcome aboard and happy Monday. Markets ripping higher around the world. Maybe some trade truces in effect or going into effect soon. We'll get to that in a second, but we're entering week 4 of the government shutdown. Day 26 here on Monday. No end in sight. No side showing any movement, any room to budge on either side of the aisle there. So we're heading into a government shutdown here. It's starting to take a little bit of effect. If you think about those missed paychecks by federal workers, those furloughed workers, they're heading into their second week of missed paychecks. That's going to add up after a while. And then you're going to start to see more contractors, more private contractors, maybe get their projects delayed or their people furloughed. So this could get worse a lot faster. The record again, 35 days. That was back in 2018. We're at day 26. And again, no end in sight here. But we do have a potential tariff truce that has markets ripping higher around the world. Over the weekend, the U.S. and China saying, maybe, just maybe, there's room for negotiation here. Secretary of the Treasury, Scott Bessent, over in Malaysia, along with the trade group, the trade contingency from the U.S. and China meeting there and saying very likely that there will be no tariffs, the 100% threatened tariffs until maybe a year from now, if they go into effect at all. And right in the middle of the negotiation is a guarantee by China, if they agree to it, to buy more soybeans from U.S. farmers. We know that's a very big deal. We know Secretary of the Treasury, Scott Bessent, is also a soybean farmer. He reminded us over the weekend. And China will reduce those restrictions on rare earth minerals that we know are very important to this tariff and trade deal between the U.S. and China right now. They did put up those potential trade restrictions, trade barriers on those rare earth minerals. And also India might be in the mix here on a deal. Their tariff rate might be reduced from 50% to between 15 and 16% here. So also in this deal is negotiations around TikTok, the sale of TikTok to U.S. buyers, including Oracle, including Silver Lake Partners, but also China's restrictions on Taiwan. The U.S. wants China to loosen its restrictions on Taiwan. Why? Because Taiwan is a home of a lot of big semiconductor manufacturers, including the world's biggest, the Taiwan Semiconductor Manufacturing Corporation. So all of these things together, soybeans, semiconductors, right? TikTok, the future of TikTok. This is our economy. This is the global economy today, right? This is semis. This is the companies that are manufacturing it. This is fentanyl, China's agreement to restrict more fentanyl, the ingredients that go into fentanyl manufacturing, the restriction of limits on Taiwan. This is where we're at right now in these negotiations, but all signs pointing to a potential trade truce, and that could mean those 100% additional tariffs on China will not be put into effect, maybe at all. And also India, I said, getting some reprieve. So that's good news. And that's got markets ripping higher around the world. Japan's Nikkei at an all-time high. You got the U.S. stock market at an all-time high, the S&P 500. And good news for investors, we're heading into the best 2 months of the year, historically speaking, for the stock market. November and December, usually you get a pretty nice pop there. And right now we're on track, given all the volatility we've had just over the past few weeks, but really earlier in the year from April, we're on track for more record highs, and we're on track for 2 of the best months of the year. And the wind at its back in terms of strong corporate earnings. We got the Fed meeting later this week, likely to lower interest rates. If not this meeting, but definitely at the meeting in December. But if you look at the CME's FedWatch tool, we're looking at a 96 probability of another quarter point cut at this meeting this Wednesday. And we're all going to be listening very intently to the press conference with Chair Powell after that meeting, whether they cut or they don't. We did hear from the Treasury Secretary again this weekend saying they've got 5 nominees potentially lined up to be the next Fed chair when Chair Powell's term expires in May. So that should be a very fascinating press conference, and we will listen closely to that. And while the U.S. stock market is at a record high right now, the bull is riding hard out east. Look at those gains in South Korea. right? 77% year to date, one of the strongest, if not the strongest developed market right now in terms of stock market returns. Japan behind it with about a 35% return, then Germany, right? Then the US. I mean, then Great Britain, then Germany, then the US right now. So things are looking good here in the US stock market for the S&P 500. Now the Dow Industrials rallying again, maybe up to close to record highs, the NASDAQ near record highs. But look east, because the returns have been out in Korea, which has been pretty much unscathed by a lot of the tariff negotiations and the tariff war. And it's looking pretty good right now. We know the president and his contingency is out in the Far East this week as well. And they're potentially setting up trade negotiations and a sit down between President Xi of China and President Trump next month. So a lot of wind at the back of equity markets right now. We got the prospect of lower interest rates, right? We got stronger than expected earnings, of course. We got more and more deregulation right now. What could go wrong? Well, let's bring in our friend Shannon Sacoccia. She is the Chief Investment Officer for Wealth for Neuberger Berman and a good friend of mine and Investopedia. She's going to drop in just a couple seconds. Good to see you, my friend. Thanks so much for joining the show.
Oh, thanks for having me, Caleb. Great to be here.
So you heard some of that, with the wind at the back of the equity markets right now. What could go wrong here? There's plenty of reasons that we could have at least fallen off. Volatility came roaring back a couple of weeks ago, but what could go wrong?
Well, there's a couple of things. Number one, I think these credit concerns and challenges that have been cropping up over the course of the last number of weeks have created at least some, pause, if you will, especially around areas of the market that have been performing really well. So if you look at financials, for instance, and this expectation that not only would this deregulatory environment, but lower interest rates really create kind of an effect into 2026 in terms of accelerating deal making. You've got a little bit of concerns around the private credit part of the market. You also continue to get a lot of questions on valuation. We've had this meaningful amount of capex, and if you back out the AI capex over the last couple of years, growth doesn't look quite as robust as it does with those numbers in there. And so, what is going to be really the next catalyst in terms of picking up the baton, if you will, from that AI capex, these hyperscalers, and seeing, that evidence that that's been broadening out. The last thing is that, you're looking at asset classes year to date. For a risk on trade with gold up over almost 60%, there seems to be a little bit of a mismatch, or that seems rather counterintuitive. So, really investors trying to figure out, hey, is there something here that we should be more concerned about? Is this prescient of, reaching a bubble stage in other parts of the market? All of those things, I think, are at the confluence of what could go wrong, although we really haven't seen any extended weakness over the course of the last couple of months.
Yeah, well, as the Chief Investment Officer, it's your job to think about what could go wrong. But when you look at the asset classes, those returns year to date, any of that on your sort of bingo card going into 2025? I mean, gold has actually been rallying for the last couple of years quietly, but it wasn't until this year we had the big breakout. But when you look at outside the U.S. especially, and what's been happening in other parts of the world, any of it surprise you?
I wouldn't say necessarily surprising, perhaps the magnitude of the performance. But again, Caleb, that's based on the fact that we've continued to see weakness in the dollar. And if you look at 2026 and look at the dollar outlook, if you're a US investor and you're potentially going to experience a stagnation of the dollar or further weakening of the dollar, that really does point to that diversification that's altogether necessary in terms of building out your stock portfolio. The other thing to think about is that we talk a lot about concentration in the US market. I would say the indices that you have here are just as concentrated, if not more concentrated, in sort of those top 10 names. So thinking about that underlying driver of whether it's increase in production, things like defense and aerospace, and then AI, there's a correlation here that I think is important. And so combining the weaker dollar with some of the concentration that we're experiencing in the US market in these other markets, I think it's an important point, and points to the fact that you want to make sure that you're getting that diversification that you think you're getting.
Yeah, I want to talk about what actual diversification looks like today in a minute. But in your recent notes and in the great podcast you guys do over at Neuberger, you've been talking about small caps, which you thought would be breaking out because we're going to get lower rates. Small caps do like lower interest rates. But what's the flip side of lower interest rates besides the fact that we could get a little more inflation? What are you concerned about as the Fed either prepares to lower this week or in December?
So our view is that the Fed will lower this week. I can go on record and say that. I think what you want to consider, and this is relevant for the small cap argument, is why the Fed is lowering interest rates. Do they believe that there is likely to be a pronounced deterioration in the economy? Well, that doesn't bode all that well for more cyclical aspects. But if they're lowering rates because they feel like they're unnecessarily restrictive in this environment, and they're creating some insurance, just as they did, frankly, in the fourth quarter of last year, creating that insurance from an interest rate perspective, creating some insurance as we go into 2026. But the challenge with inflation is that, if you look at ISM, for instance, producer prices paid, those are certainly indicating that there are some tariff impacts. But if you look at PPI, which should be the precursor to CPI, we haven't seen a pickup in PPI either. So someone's digesting and ingesting those price increases. It's not really being passed on down the line. And so I think what's important is to think about, okay, if inflation remains benign, this absence of data right now on the job front probably speaks to supporting the Fed to be a little bit more aggressive. They've sort of planted their flag on that. And so without other data, they're likely to be accommodative in the October period, probably as well in December. And so it's really why they're cutting. And for us, we feel like they're cutting because they're looking to create a little bit of insurance around unemployment rather than, evidence of a more pronounced deterioration.
Well, you and your team watch this very closely, and I've also heard you say that it's really fiscal policy right now that matters a lot more than monetary policy because we know the direction of where the Fed is going to be taking interest rates probably over the next year or two. They put it out in the dot plot, and if you look at where Fed fund futures are going way out into 2027, the direction is down and to the right. But it's the fiscal policy that seems to be the most important term, the most important metric right now. Why?
Well, certainly for 2025, it was. If you look at fiscal and you think about the concerns about fiscal sustainability, the volatility we had at the long end of the yield curve, all of that was tied back to fiscal policy. But yet, we're sitting here in the midst of a shutdown, which you did a great job of outlining where we're at. And there actually doesn't seem to be that much concern, at least from a capital market perspective. I think that could change as we sort of lap November 1st and some of the challenges that will create in terms of other departments that are not going to be funded. But most importantly, what is the expectation for fiscal spending next year? I think with a benign economic growth outlook and the tariff revenues that are coming in, so combining stronger tax revenues with tariff revenues, I think fiscal actually starts to potentially move into the backdrop a little bit in 2026. And most importantly, one of the things we're just starting to talk about for next year, Caleb, is this combination of fiscal and monetary stimulus has acted as an accelerator for the US economy. Going into 2026, we think the private sector is going to need to do that. And so we need that AI CapEx to start to expand. But again, both monetary and fiscal are likely to be neutral to accommodative and certainly not restrictive in 2026, which gives some credence to the expectations for stronger growth.
Yeah. Well, you got put out a great chart in one of your recent notes about the AI promise and all this money that is going in to the CapEx spend. Will it ever be fulfilled? The question is, I guess ultimately maybe, and that's what these companies are betting tens of billions of dollars. But how much patience will investors have for the promise of AI to be fulfilled, just in terms of how much money these companies are spending quarter after quarter?
Well, our view is that they're not going to need to have as much patience as they did in the early 2000s, Caleb. If you think about the sort of the dot-com bust, and it took several years for, I would say, more traditional businesses to really start to infuse investment into the internet and make that part of their businesses. I think what you're seeing now is just in even areas like professional services hiring, which is way down and much slower than it has been over the last number of years, especially in a fairly robust economic environment. You're seeing that companies may not yet be committing to meaningful capex, but they're anticipating that they're going to start to see some benefits from AI. And so we would expect this investment to pick up in 2026 and into 2027. And I think that's an important piece. You can start to see a plateauing of AI capex out of the hyperscalers. that the economy can digest that as long as you start to see that pick up elsewhere. And so I think this monetization does need to come for the hyperscalers, but it's going to come in the form of other companies indicating their investment and following through on that investment. I think the tip of that spear, though, and evidence for us is again that lower hiring. It seems like companies are anticipating that they're going to be using AI the same way they started to use the internet in the early 2000s.
Yeah, which leads me, and I think a lot of people to wondering, well, if what's important right now is their productivity, and that's what AI implementation is all about, and the spend is all about, and productivity is measured in revenue per employee or your gross profit margins, that ultimately is going to impact the labor market. Everyone's talked about it. It's not like it's going to replace all the jobs, but it will replace the people that don't know how to use its jobs, and that could be a lot of people when you think about a digital divide here in this country and around the world. At what point does that start to concern you that, hey, companies are getting crazy productive and their margins are really expanding, but at the same time, spending is going to go down because there's not a lot of people working out there?
Well, these periods of productivity enhancement, we've seen these, and they come with innovation. So this is not a there is precedent for this, and we do expect that there's going to need to be a right sizing of certain workforces. But I would say if you look at Oracle's president Larry Ellison, for instance, he's talked about the importance of being able to bring in younger employees who can apply this innovation and think about things differently. And so yes, there will be job disruption. We anticipate that. We're seeing that in that 16 to 24-year-old cohort right now in terms of hiring. But I think what's most important is that we've been through these cycles previously. While we may see an incremental tick up in unemployment, on the back of this over the next couple of years, the U.S. labor force is a dynamic one, and we will figure out a way to do that. The other thing is to think about what won't be disrupted by AI, right? We've already have on record over the last 10 or 15 years documented many documented articles on the necessity of people, for instance, and the malaise of everybody going to a 4-year university for a liberal arts degree. Perhaps this accelerates what frankly is necessary for us to do things like bring production back onshore, manufacturing back onshore, having a new crop of workers, many of whom retired in the COVID years. Now, these new workers coming into these areas like manufacturing and production, perhaps they will have that technical background. And so, again, it might be messy in sort of the interim, but we have seen this before, and we have seen the US economy adjust to these innovations.
Yeah, it's a fascinating experiment and one that's not going to play out in 1 year or two. This is transformational. All right, let's talk about how you would and how you are advising people to construct a really strong multi-asset portfolio today, because one size is not fitting all. You could just be an index investor if you want, but it's a complicated investing environment, and it's very changing very dynamically. So how do you, from your perch at Neuberger Berman, construct a really diversified, strong, resilient multi-asset portfolio as we head into 2026?
I think the concept of risk has really changed over the last couple of years. If you think about investing from a passive perspective in an index, the risks that are embedded in those indices, as I talked about earlier, not just here in the US, but elsewhere, there's a significant amount of concentration. The other aspect of this is that we have seen so much. There's been so much of a narrative that's been built around private markets, but really understanding that in many cases, if you're thinking about equity or thinking about credit, private markets are really just an extension of public market. And so thinking about that credit frontier, thinking about that equity frontier, those are incredibly important. The other thing is if this was 2006, Caleb, you would be sitting here asking me, why are you even investing in the United States, right? There was so much enthusiasm around the commodity super cycle and emerging markets, developed ex-US, just a lot of investment was pouring into those markets, and the US was really left behind, as we see on this on the earlier graphic. So I think what's most important is to understand that you're not going to be able to time any of these things. And despite the fact that we've seen some strong performance, for instance, in developed ex-US stocks, we have a very constructive view on Japan over the course of the next number of years. And so that speaks to making sure that you have that exposure to that opportunity. So again, our view is make sure that you're diversified on the fixed income side in both credit and duration. Make sure that you have geographic and cap weight diversification in equities. Make sure that you're really understanding the underlying fundamentals of the investments that you have, particularly in the equity market, given some of the frothier valuations that we're facing, and not forgetting about the private markets and in some sort of extension of your longer term portfolio. The last thing is that there's some real evidence that there's potentially we've moved into this higher inflation environment. So that really does speak to areas like commodities and equities. And again, it's a great year to be a multi-asset investor just from an absolute return perspective. So just really speaking to the investors out there, look at your absolute returns this year, understand that it's not an entirely relative game. Make sure that you're really you're reallocating, you're redistributing that capital as you move into 2026.
Yeah, it takes a lot right now to construct a resilient modern portfolio. You do such a good job of explaining it, and we will link to all the good research and the insights you put out with your team at Neuberger Berman. Shannon Sacoccia, the Managing Director and Chief Investment Officer for Wealth for Neuberger Berman. Thanks so much for joining the Express. Good to see you, my friend.
Thanks, Caleb. See you soon.
All right, Shannon and her team do such good work. We'll make sure we link to all that good stuff in the show notes. And they put out a really nice podcast over at Neuberger Berman we will link to as well. Well, it's time to hit a little bit of money in motion. And where's the beef? Where is the beef? Because shares of Beyond Meat, the non-beef beef, former meme stock, are now back into the meme stock ecosystem, back into our consciousness, thanks to a post out on YouTube last week. Shares hit an all-time low last week of Beyond Meat as the company made some moves in its balance sheet. This was basically allowing a stock swap to retire some convertible notes. Shares hit an all-time low last week. That obviously leads to shareholder dilution. And it looked like that stock was heading towards zero. And then this post from a YouTuber, calls himself an amateur investor, Capybara, yesterday, talking about, this is an AI video. I'm not going to play the video because it's ridiculous, talking about why he sees value in shares of Beyond Meat. That stock was up over 300% last week. Beyond Meat, out of nowhere. It's not like we're eating more beef substitute or vegetarian beef. In fact, it's only 1% of the protein market. But all of a sudden, this stock was on its way to infinity and beyond. BYND. You get the pun. Silly stock move of the week last week. Shares of Beyond Meat rising over 300%, falling a little bit at the end of the week and into this week as investors realize that there is not a lot of beef behind this story. This was a meme stock back in 2021. This was a meme stock back when it first IPO'd. There is a market, right, for non-animal protein, and Beyond Meat is one of the leading companies, but it's still a very small market. So no reason for that stock to shoot up over 300%. And dare I say, and I don't want to be no turkey, this close to Thanksgiving, but this is exactly the kind of thing we start to see and smell when things get a little frothy in the market. When you get meme stocks like Beyond Meat popping 300% in a week, and it's not the only one, you know that something's up and it's time to pay a little bit more attention. It's not like this is Roaring Kitty talking about GameStop, which is another one of those meme stocks and still one of the most shorted stocks. But when you see things like this, be a little bit cautious. This is a sign that things have gotten a little out of hand. All right, let's get set up for a busy weekend, maybe the busiest week of the year this week, as we get into a big week of earnings, but also the FOMC meeting. Let's see what's coming down the tracks at us this week. Massively busy week this week. Starting off with earnings today from Waste Management and Keurig Dr. Pepper, but a massive week because we do and will hear from members of the Mag 7, including Apple later on this week, as well as Microsoft, as well as Meta, as well as Alphabet, Google, GOOGL, reporting earnings this week. Tuesday, massive week for earnings results, but also the consumer confidence report for the month of October out. And then Wednesday, big Fed decision. FOMC decision coming in. Fed meeting Tuesday and Wednesday of this week. Again, as I showed earlier, 96% chance the Fed cuts rates at this week's meeting. If not this week, definitely in December. But it's the press conference we want to listen to, especially given the news over the weekend that from the Treasury Secretary that they've already selected their 5 potential candidates to replace Fed Chair Powell when his term expires in May. Thursday, earnings out from Apple and Amazon and Eli Lilly, plus the GDP Q3 report. The second one of those will come out. We'll see how fast or slow the economy is moving right now. Friday, earnings from ExxonMobil and Chevron, and then the delayed release of the PCE index. But first, Thursday, October 30th, big birthday. Thank you very much. Got a big birthday coming up, my favorite week of the year, birthday week. And then Friday, Halloween, of course. Get your jack-o'-lanterns ready. And let's hope we don't have one of those triple witching Fridays this Friday. I don't think we have one on the books, but a very busy week indeed. So get ready for the week ahead with Investopedia, our news team out here, sitting right outside the room here, working hard on setting you up for the week with the earnings previews and all the news that educated investors like you need to know. All right, let's get to our indicator of the week. As we talked about Beyond Meat, silly beef price, silly stock move of the week last week. Well, the indicator of the week's deli meats. We got that inflation report last week, the CPI, the Consumer Price Index. And although food away from home, what we buy at the grocery store, that rose just a little over 0.2%. It was deli meats that were the standout inflationary item in the Consumer Price Index last month, rising like 12 or 13% or 4.2% in September. That's the largest monthly increase for your bologna, your salami, your ham, your turkey on record. That far outpacing the rest of food in inflation. And what's beyond that? What's beyond meat? What's beyond the rise in deli prices? Well, commodity prices for one, but for some reason that stood out as the big surprise shocker when it came to the inflation report last week. But when it comes to real meat and real companies, well, I got to tell you, I was just in Bentonville, Arkansas. And if you've never been to Bentonville, the home of Walmart, I recommend you go. And when you go, make sure that you stop by the Walmart Museum in downtown Bentonville. They got a Sam Walton's office replica remade inside the museum there. There's Sam with his bird dogs. Sam loved dogs. They got an AI-powered hologram of Sam Walton, the founder of Walmart, talking about his first stores, talking about his dogs, how he used to let one of his dogs sleep with him in the room when he was on the road. Remember, Sam Walton started this company with one store in Bentonville, Arkansas. Now it's the biggest retailer in the world, the largest employer in the United States, and the highest revenue producing company in the United States as well. From a little dream of stacking them high and letting them fly to the biggest company, biggest retailer in the world, that's Sam Walton. But if you want the real deal, you got to go to Wright's Barbecue right there in Bentonville, Arkansas. Not only do you get the Walmart Museum in Bentonville and Walmart, you get Wright's Barbecue, some of the best barbecue I ever had. Wright's Barbecue, Bentonville, Arkansas, the triple meat platter. You're seeing it right there. Yeah, I did it. The ribs, the turkey, the brisket. Oh, yeah, that sweet potato and the coleslaw, the hot sauce, the spicy sauce. That was perfection. Chef's kiss, thanks to you over at Wright's Barbecue in Bentonville, Arkansas. And thanks to all of you for joining us here on The Express. We love it. We love when you chime in. Good special thanks to our friend Shannon Sacoccia from Neuberger, Berman. I've known her for years, and I always learn so much from her research. I'll make sure I share that with you all in the show notes. We are live and direct here every Monday on the Investopedia Express on all your social platforms and then on demand wherever you get your podcast. So to all of you following us and watching us from around the world, we know you're out there, the smartest investors in the world. Watch the Investopedia Express. Thanks so much for joining us, and we will talk again a little further on down the line.